On March 25, 2026, the Ontario government, led by Premier Doug Ford, tabled a provincial budget containing a policy the Ontario Home Builders Association categorized as the largest of its kind in decades. The core financial mechanism of this policy is the temporary elimination of the full 13% Harmonized Sales Tax on eligible newly built homes. This complete tax exemption is applied strictly to home valuations up to a $1 million threshold. This chart compares the historical maximum rebate against the newly announced parameters. Under the previous rules, buyers maxed out at roughly $24,000 in tax relief. The updated parameters push that ceiling to $130,000. Dissecting that $130,000 peak, it is constructed from two components: up to $80,000 in provincial tax savings and approximately $50,000 from the federal portion. For developers and investors, stripping 13% off the top-line cost alters the underlying cost basis of entering the Ontario market. The provincial government designed this specific maneuver to inject liquidity and spur new construction, attempting to counter a notable slowdown in the housing sector. This is an aggressive macroeconomic stimulus. For sophisticated real estate investors, it dictates an immediate recalibration of your acquisition strategies and ROI models. Realizing this capital efficiency requires operating within a strict execution window. The agreement of purchase and sale must be signed explicitly between April 1, 2026 and March 31, 2027. The province expanded the eligibility criteria, permanently removing previous clauses that restricted these rebates strictly to first-time homebuyers. Repeat buyers acquiring a newly built home to use as their primary residence now fully qualify for the capital retention. The policy also explicitly covers real estate investors, provided the acquisition is designated strictly for long-term residential rental purposes. Eligibility is tied to rigid construction schedules. For primary residences, construction must commence on or before December 31, 2028. Furthermore, that primary residence must reach substantial completion by December 31, 2031. Investors acquiring residential rental properties face a tighter operational timeline. Those assets must reach substantial completion 2 years earlier, by December 31, 2029. Capturing these efficiencies demands precision. Investors must secure contracts within a narrow 12-month window, while guaranteeing their builders can reliably hit rigid multi-year delivery deadlines. This graph maps the net HST paid against the pre-tax purchase price across a 4-tier mathematical structure. In Tier 1, covering properties up to $1 million, the effective tax rate drops exactly to zero. On a $500,000 asset, the standard $65,000 HST is entirely rebated, generating $41,000 in additional savings. Pushing to the $1 million threshold, the maximum $130,000 HST burden is completely offset, representing maximum yield. This introduces Tier 2, the flatline zone, applied to assets valued between $1 million and $1.5 million. As the pre-tax valuation rises, the gross HST exceeds $130,000, but the allowable rebate locks in at a flat $130,000, keeping the effective rate low. Take a $1.25 million home. Applying the $130,000 flat rebate leaves a net tax payment of only $32,500. Moving to the $1.5 million ceiling, the net HST climbs to $65,000, yet the buyer fully captures that maximum benefit. The primary directive is straightforward. Any acquisition executing at or below exactly $1.5 million captures the maximum absolute dollar value of the stimulus. This split-screen ledger compares the flat math of a $1 million property against Tier 3, the phase-out zone. Here, the rebate erodes sharply from the $130,000 peak down toward a static floor of $24,000. Calculating a $1.75 million purchase demonstrates this drop. Following the linear curve, the allowable rebate collapses to $53,714. Factoring in the old rules, this yields only $29,714 in true additional savings. The tax advantage rapidly deteriorates here. This brings us to Tier 4, the Zero Enhanced Benefit Zone, covering any property valued at $1.85 million and above. Crossing this specific threshold triggers an immediate reversion to the legacy provincial system. At $2 million, the federal enhancement is entirely nullified. Whether the asset prices out at $2 million or $2.5 million, that cap remains rigid at $24,000. Failing to mathematically account for the $1.5 to $1.85 million phase-out curve will artificially inflate an investor's projected yield on premium asset acquisitions. Moving beyond the theoretical math, investors executing contracts today must navigate a specific legal caveat regarding pending federal law. This flowchart deconstructs the rebate into two jurisdictional pillars, the 8% provincial share on the left and the 5% federal share on the right. The 8% provincial enhancement is active and fully mapped out. The critical caveat lies with the federal 5%. Activating this portion requires structural amendments to the Federal Excise Tax Act. Legal analyses note the unusual nature of this rollout, announcing the policy without concurrent federal legislation. While the federal government publicly committed to the cost-sharing arrangement, the necessary legislation has not yet received royal assent. Sophisticated investors executing an agreement today must price a temporary legislative execution risk into their models, relying on the expectation that public federal commitments will ultimately become codified law. Zooming out to the broader market forces, CMHC's 2026 housing market outlook projects potential price declines across Ontario. With provincial housing starts projected to hit multi-decade lows, this rebate functions as targeted liquidity support for the residential development pipeline. The mathematical directives for investors are clear. First, maximum capital retention is achieved by aggressively targeting assets priced at or below the $1.5 million threshold. Second, you must strip any assumption of enhanced tax advantages from pro formas concerning properties that cross the $1.85 million line. In a shifting provincial economy, this temporary regulatory environment heavily rewards buyers who accurately optimize their acquisitions against the government's specific yield curves. Successfully navigating commercial real estate and capturing these complex tax rebates requires expert, precise contract negotiation. Leaving tax efficiencies and legislative caveats to chance is an unacceptable risk. To secure your next commercial investment strategy and portfolio expansion, contact me, Terry Riddick. Call my cell directly at 509-591-1725. Email me at terry@terryriddick.ca or visit www.terryriddick.ca to begin mapping out your next transaction.